Listening to or watching my podcast for some time, you know that I believe in the importance of having a long-term strategy, a strategic plan for your investments. So while you may be looking for the next hotspot or a way to get rich quickly, let's just step back today and look at the advantages of a long-term investment approach. And I'd like to explore with you how to sidestep some of the common pitfalls and discuss why playing the long game could be your best move to secure your financial freedom. And to do that, today I'm joined by Stuart Wemyss, a seasoned financial advisor, author, and an expert in devising long-term strategic plans that have stood this test of time. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of the many mixed messages regarding our property markets so they can develop financial freedom, the freedom they're looking for through strategic property investment and smart money management. Let's get on with today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
So welcome back again, Stuart.
Thanks, Michael. Thanks for having me back.
Well, I know in that particular blog you wrote, somebody whose blog you were quoting, and they said the definition of strategy that he uses in his day-to-day is that a good strategy is defining the right sequence of steps that helps one navigate the trade-offs and achieve an end outcome. I actually think that's a pretty smart definition of a strategy, Stuart.
Yeah, and it got me thinking about how it applies to finance and financial plans. And I was thinking, well, when I was reading that definition, I was thinking, okay, so sequence, well, that really speaks to, invest in assets that are going to provide you compounding capital growth for a long period of time before you start thinking about assets that are going to generate income. So that's really property before shares, if you like. And navigating the trade-offs. There's a lot of people that earn a lot of money but don't have a lot of wealth to show for it, and people that earn significantly less money than that are able to build wealth. Well, that's just all about delayed gratification and trade-offs. And end outcome made me sort of think about, okay, well, what are we aiming at? Where are we heading? And so I thought it was a really apt definition of strategy, and it had a really firm application to building wealth.
Well, one of the things we've mentioned a few times already today, but we have discussed this frequently on our chats together, is the idea of having a long-term investment strategy. So first of all, we know that many investors don't even have a strategy. Buying a property is not a strategy. Going out to open for inspections is not research. So I think the definition of strategy, having a defining sequence of steps in the right order, makes sense. But you've also got to have one that, in my mind, is proven over the long term. Because at the moment, over the last couple of years, Stuart, some of the strategies I've seen have swapped to trading. In fact, a few of the inexperienced buyers agents, the new ones, the enthusiastic amateurs, are taking. We both have a mutual friend in the industry in Perth who told me that the buyers agents who are putting people in Perth are now ringing their clients and saying, hey, time to get out of Perth. I'm going to put you in the next hotspot. That's a trading philosophy. Now, those guys probably will do well because they bought at the right time and the Perth market went amazingly well. But to me, that's not a sustainable long-term strategy. You're going to get caught out.
No, that's right. I was having the exact same conversation with the exact same person last week, Michael. There's this great quote from Howard Schultz, who built a Starbucks empire, and he says that short-term profit almost never drives long-term value. Now, he was saying that in respect to building a business, a company, or in respect to a listed stock, but it's true really with anything. That, if all you're doing is aiming at short-term profit, probability is you're taking a much higher risk, and at some point that's not going to work out, and as a result doesn't create long-term value. And I think having a long-term strategy is so important. But I guess the thing is that, if you can sit down and have a really comprehensive strategy, of course, that's much better than just a basic strategy. But even a basic strategy is better than no strategy, and it does really force you to think about kind of where you're going, the long term, all those sorts of things. And that's what this quote got me thinking about as well is, yeah, there are some of those things like trade-offs. Like if I'm going to not go on a holiday this year just because I want to buy my next investment property, for instance, I want to make sure that that trade-off is going to be worthwhile. And just before we started the recording, we were talking about how important holidays are in terms of, from your standard living and enjoyability. So it's a significant thing to forego. You definitely want to make sure that it's going to be worthwhile. And so that quote got me thinking about what else is there in building a long-term strategy? What other benefits? And the thing is, Michael, that what we find in our business is that some of those benefits aren't obvious at the beginning. So that is when people decide, yes, we need a long-term strategy, they might think that for A, B, and C, like there's 3 reasons why they want that long-term strategy. But when they actually get into it, they realize that there's a whole host of unexpected benefits as a result of doing that planning. And that's what I hope to dive
Well,
into.
let's work through that and see. So I guess the plan tells you what to do, but what not to do. So if you've got somebody independent strategic planning for you, because sure, you could try and do it on your own, but I know we both have vested interests. You help clients with their long-term accounting, financial, mortgage planning, and we help clients with property planning. But I do believe that you should have somebody unbiased and independent helping you. But let's go through the top 10 benefits. Now, I'm going to give a link to your article in the show notes. But I guess as we go through those, we can talk about that delayed gratification and what not to do and the importance of the trade-off. So number 1, what's the first real benefit from having a long-term plan?
It gives me context to make financial decisions. If someone stops me in the street and says, Stuart, should I buy an investment property? I don't know. I mean, it's probably a good idea, but equally, I mean, depending on your circumstances, it might be the worst thing that you could do at this stage. If I don't know kind of where you're heading, it's a little bit like, leaving home, jumping in your car without a destination, or even thinking about the most efficient way to get to your destination. You just drive around aimlessly. So having a strategy gives you context for making decisions like, when can I reduce working hours? Can I go on a holiday this year? What is the impact if I upgrade my home? Can I send my kids to private schools? These sorts of things. If I've developed a long-term strategy and a client comes to me and says, can I send all my 6 kids to private schools? I can put that in the financial model and projections and work out, is that affordable or is it not? Is it going to come at a potential cost, in terms of lost growth or whatever? And is that going to compromise retirement? I can answer those really important questions and considerations when contemplating either a lifestyle or a financial decision. And so I think context is really important. It's impossible to answer those questions with a high level of certainty without understanding what is somebody's strategy, where are we heading, how much money do we need to get there.
Well, it's interesting how much we're on the same page, but I guess that's partly why we're good friends as well as professional colleagues. On a regular basis, I get comments left on Property Update and also on YouTube. Should I invest in the Gold Coast or should I invest in, they even give me a specific property. And I always disappoint them by saying, I don't know. I don't know how old you are. I don't know what other investments you have. I don't know what your risk profile is. I don't know what your timeframes are. I don't even know what you're trying to achieve, because what suits me and you, Stuart, who've got a very substantial property portfolio, won't suit somebody who's still at the accumulation phase of their portfolio, or won't suit somebody at the beginning. So context is a really critical one. I'm glad you put that first.
It's almost jumping to tactics. You need strategy before tactics is another way of saying it. So, tactics are, let's go and buy in the Gold Coast, but strategy always has to come before tactics.
Yes, sure. Okay, and I guess that leads into your second point, because having a strategy forces you to define what you're working towards. You know where you are now, but you really need to understand where you want to get to, Stuart.
Yeah, the traveling destination is a good one that I'll use again in terms of jumping into your car. I mean, you just wouldn't jump in the car and drive around aimlessly. Of course, you're going to have to define a destination in terms of where you want to get to. Now, that can be difficult for people, particularly people that are, that are many decades away from retirement. I mean, if I'm in my late 20s, for example, I don't know what my life looks like when I'm 60 or beyond 60. So the destination doesn't necessarily just have to be retirement. It could be some sort of shorter term goal, or I probably should describe it as a medium term goal. So if I'm in my 20s, how do I buy my dream home in my dream location, for example? Because it could take kind of several steps or several tactics, if you like, to actually get to that goal. But even just a broad goal like, I want to have $120,000 in today's dollars for living expenses by the time I'm 60. And I want to have a perpetual portfolio, which means that I can spend $120,000 and my net wealth doesn't really change, or it
Yes.
continues to appreciate. Because then at least then I've got, really a lot of confidence that I'm going to have surplus funds. So it can
Well,
be
having a strategy, Stuart, having a goal, that can change over time, but at least you start with the goal and it will change over time because your expectations will change. Most likely your income will. And there's no doubt between now and then, whenever then is, the rules are going to change. Are you going to be able to borrow against your superannuation or not? Maybe you can't get it for a long time later in life. Maybe the government's going to change other tax rules. So I guess while you've got to have a strategy, I guess it wouldn't be set in stone. You've got to review it and change your goals.
And the really important part of setting this goal is, there's two parts really. The first part is obviously then it gives us a way of sort of back solving in terms of working out what strategy needs to get you there. But also, and a big part of it is it really does force you to think and make long-term financial decisions. We all know that there's a lot of short-term media noise out there. What property markets have done over the last month, what might they do in 2025, for instance? That all makes for interesting information to consume and think about, and good dinner party conversation perhaps, but it doesn't really help inform us in terms of investment decisions. But if I'm in my 30s, for example, and I'm thinking about what can I do today so that when I'm in my 60s, I'm going to look back and thank my 30-year-old self in terms of what is the most beneficial or effectual investment I can make today. That's the benefit of having that long-term goal, because it does really force you to do that and drown out all that useless short-term noise.
That makes it much easier to drown out the short-term noise, because otherwise it's so easy for the media to grab your attention, and we know that most of the media gives us negative messages. I guess it also helps you decide what trade-offs are worthwhile. In other words, you already mentioned a moment ago delayed gratification. We know that if you do the easy things now, you're probably going to have a harder time later. And if you do the harder things now, hopefully you're going to have an easier time later. But sometimes it's hard to decide, is it worth delaying the gratification, not having the holiday and not having the new car, or maybe not upgrading my home before I buy an investment property?
Yeah, so if we come up with a financial model that tells us if these clients can really knuckle down and make these investments over the next 5, 10 years, whatever it might be, and the consequence of making those 5 investments means that they have relatively limited surplus cash flow over and above general living expenses. So maybe that there's not a lot of holidays in there other than maybe some small domestic holidays. And we're confident that that plan is going to work for them. That gives them a really good context of, well, at least it puts them in the position, are we willing to make that sacrifice? Knowing that if we do, nothing's guaranteed, but the probability is that we well rewarded for that in the long term. There's no point making that sacrifice without a plan, because how do you know if it's going to actually work out, or in fact that there's a better way to approach it that doesn't even require that sacrifice? So at the beginning of building wealth, quite often, we've got a very low asset base, limited income as our career grows, hopefully. So we've got fewer sort of financial choices. And quite often in that situation, not going on the holiday or not being able to eat out or enjoy those leisure activities can have a big impact on our standard of living. So that's when that delayed gratification really kicks in. Of course, as we have become more established and our income's higher and those sorts of things, there's typically fewer trade-offs to make. So if you're going to make those trade-offs at the beginning of the investment cycle, you really, to my mind, want to make sure that it's worthwhile doing. And, my view is, for me and my wife, we love going to nice restaurants and we love traveling. And so if we didn't do those things, that would have a big impact on our life. Now, we're happy not to do those things if we really need to in order to build wealth. But if I'm going to make that commitment, I want to find every avenue possible to make sure that I will be rewarded for doing so in the long run. So it doesn't make sense to me when people don't have a long-term strategy if they're really, really focused on building wealth. And the FIRE movement comes to my mind,
Yep.
Michael, in terms of, and we can, I mean, that's another
Whole
topic for
discussion
another
on its
day.
own.
Yeah. But, if that's the strategy, is to invest as much as possible so it can retire as soon as possible, I would say that anyone that wants to pursue that strategy should be, the first thing they should be doing is investing in a strategy to find the path, the quickest path to get where they're going. But quite often those people in that sort of mentality don't want to pay for advice or feel like it's an avoidable cost, which it is. You can avoid it, but at what cost? So I think the trade-offs, making sure the trade-offs are, I think it's a really important thing, because we're building wealth is a marathon. It's a bit of a journey. It's not really a destination. So to my mind, hopefully we can achieve some balance, which is spend some money today, enjoy life today, because you could get hit by a bus tomorrow. But at the same time, make sure that you are investing for tomorrow on the hope that you obviously are still alive and you can still enjoy it.
Well, one of the things you just mentioned makes me also realise another real benefit of the strategy. When you said you and your wife have got particular goals, it actually brings partners together, because very frequently I see one of the partners more excited and involved in investing and property, and the other one going along for a ride. But by having a written plan, by having a strategy, by both being involved in developing it and maintaining it, it puts you on the same page, Stuart, and it makes it easier to make those decisions.
Yeah, that's right. And I find in my experience that spouses might get different value from putting a plan together. So we talk about these 10 benefits today, and a few of these will resonate with one spouse, and 3 or 4 other ones will resonate differently with the other spouse. So I find, it's either, the comfort, the comfort of knowing that you're on the right track, that you are going to meet your goals, that what you do actually need to do over the next period of time in order to meet your goals. That can be one of them. And then quite often for the other spouse, it can be, keeping you on the straight and narrow and working out exactly what you need to do. And it's really the tactics element to it. But being on the same page is, I think, incredibly valuable, particularly if there are sacrifices to make, because at least then you can, typically one spouse is typically more interested in the money than the other, I find.
Yes.
So you can, let's call them the disinterested spouse, you can at least get their buy-in to say, hey, we're going to make these changes or these sacrifices over the next couple of years, but here's the reason why and here's the expected benefits.
Well, your fourth tip in your blog was knowing to do the right steps in the right order. And I think that's very important. I mean, we've already sort of explained that the last step is eventually investing, whether it's in property, shares, ETFs, whatever. But most people put that first. But there are a whole lot of decisions that have to be made, and generally in the right order, Stuart.
Yeah, that's right. And the obvious one is, do I invest in property or shares, or do I upgrade the family home first before you start making any investments? There's some general sort of questions that people have in regards to sort of investment life cycle and timing, but it can be even more nuanced than that. So if we're talking about property, what are the attributes of that property am I looking for? Which attributes in terms of capital growth and income are going to suit the strategy and make the strategy most effectual? Or could it be something like, should it be residential or commercial property? Again, that is a timing issue, what order to do it in issue as a general rule, not an exclusive rule, of course. So it's really important to make sure that you want to take the most efficient path to where you're getting to, where you want to get to. And efficiency can come in terms of not only dollars built in terms of wealth built, but it can come in terms of cash flow, risk management, tax efficiency, all those sorts of things. So taking the wrong steps in the wrong order, of course, that still might work out, but it could be the least efficient way to get there, which of course
Hard work.
avoid. Exactly
Definitely.
right. Yep.
A strategic plan, and we have a strategic property planners, Metropolitan, you in your accounting and financial planning business have more detailed financial strategies as well. One of the elements is the investing, but we also like the concept of tax planning, insurance, finances. They all interrelate. And I know you have an accounting background. You're an accountant in your firm that does accounting. I'm sure that's an important part of the planning.
Yeah, and that was the fifth benefit, Michael, which is really the ability to do proactive tax planning. And, you know, tax is one of those things that is available for anyone to optimize if they're going to take the right approach. And it's so often I see investors that have made the wrong decision 10, 15, 20 years ago. You try and optimize the tax consequences as a result of that poor decision that many years ago, but it's not always possible. So the best time to do tax planning is actually before you buy the investment. And then you really then think about, well, how does this fit into the plan? Is it an investment that I hope to buy and never sell? Or is it part of the plan to divest of this investment at some point during the strategy? And then what do the investment return attributes look like in terms of capital growth versus income? Are there going to be any tax credits associated with that income? What does the gearing profile look of the asset? And so then, I mean, tax is only one of many considerations that you need to think about when putting a plan together, but it's a really important one.
Yes.
And particularly for POYG individuals, they would know that they don't have a lot of, other than gearing into investments, they don't, in super contributions, they don't really have any other meaningful way to minimize tax. So particularly in their circumstances, if you're not able to minimize tax during your working life as much as you'd like to, then you certainly don't want to pay any more tax than you need to in retirement. And so the best way to achieve that is to be at the front end of that journey. And that's the problem with getting tax advice only from an accountant, and I'll come back to that in a minute because it sounds like a silly sentence to say, because they might not necessarily understand how that asset is going to be used in your plan. So they might be too focused on the short-term outcomes. What do we expect the tax attributes to be in the next financial year, for instance? Whereas what we would like to do is take a more balanced approach and think about how is the tax going to play out in the short, medium, and long term. And what we're trying to find is a balance that optimizes the tax outcomes over that period of time. So you shouldn't take tax advice, of course, though, from someone that's not a registered tax agent. So I'm not suggesting you go off and just take tax advice from anyone. But that's the benefit of having that longer term plan, is that you can go to your accountant and say, here's my long-term plan. This is the assets that I'm going to invest in. I'm going to sell these assets. I'm going to keep these assets. These are the tax attributes, et cetera, et cetera. And the accountant, a good accountant, can then just look at that and balance it all out. And the more information they have in terms of how you're going to utilize these assets, the better the position they are in terms of structuring the ownership and therefore the ongoing tax consequences of them.
Now, there are 5 more points that I want to run through with you, but this is probably a good time for you to explain why you've even got the credentials to discuss this, because I know your team at ProSolution Private Clients does this on a daily basis. So what do you do and how are you different to other people who offer financial, tax or finance advice?
Well, we endeavour to be a holistic firm, which means that we work with our individual clients on a holistic basis. And the benefit of that is the accountants, mortgage brokers and financial planners get around the table and talk about the client's strategy initially and their annual
Which is
review.
exactly what you were saying, and that's why I thought this is a really good time to explain why you do it.
Yeah, and it's a really interesting exercise because every time we do this, someone will have a different perspective, whether it's another financial planner critiquing one of my strategies or whether it's one of the tax guys that comes up with an idea that I hadn't thought about. And you get those fresh eyes, but it's because a lot of things are multifaceted and multidisciplinary. Investing in property is a perfect example. We've got loan structuring, we've got borrowing capacity, we've got tax consequences, we've got financial planning. You know, there's a lot of outcomes or considerations that need to be thought of when discovering that. And that's exactly what we do at ProSolution. We work with clients to make sure that we're uncovering all those opportunities and managing any risks that where necessary.
Well, I'll leave a link in the show notes and also to your blog because I think it's a great one that people should subscribe to. You don't overwhelm them. You only send something out once a week. So that's great.
Thank
As
you.
we go through the list now, there are a few more. The next one on your list in your great blog was by having a strategic plan, it helps you help your family when it's the right time for them and for you.
Yeah, that's right. And it's a common goal that a lot of clients talk to us about in terms of, why do you want a financial plan? Why would you like to build wealth? And they're always of the mind to think about, how are we going to help our children or any other beneficiaries that they might have in mind? And quite often that means, or a subset of that is helping them get into the property market, recognizing that obviously it's more expensive and it will be more expensive by the time that they get there, particularly if the children are young. And so quite often people then ask us, well, what does that look like? Should we go and buy an investment property today that we could eventually transfer or hand over to our kids? Or should we use investment bonds, education bonds, these sorts of things? And our general answer to that is, well, if you can come up with a strategy that makes sure that your financial position is as strong as possible, and that it will result in you having surplus assets, which means more assets than you need to fund your retirement, then you'll be in a great position to help kids. Because I guess if we have a bunch of kids, we don't really know what ages will they need the help, whether it's going to be the right time. Some kids might not want it or need it. Other kids might need a little bit more help than the rest. And you've got to have that flexibility. So at least and then the other element there is early inheritances as well, which
Yes.
means that really passing on that wealth before it actually ends up in your estate, so before you die. A lot of people are thinking about that now because we tend to receive inheritance much later in life. Once we're already kind of financially established, it's a bit of a shame really when we could have really used that money well, a couple of decades prior. So at least when you have a well set up out plan, and we've done it for many of our clients, they can come to us and say, look, we would like to gift this child or both children or whatever it might be, $500,000, for instance, and we can work out, yep, that's affordable. This is how we'll fund it. You're not going to compromise your own retirement. And they've got the confidence in order to do that.
People living a lot longer now into their 80s and some much longer than that. By the time they pass the money on to their kids, they're already probably in their 60s and they don't need it anymore. So I know that you're aware that we've helped out not just our kids, but also our grandkids. And I can see the pleasure and enjoyment of that. So it actually just doesn't help them only, but it also is great for Pam and me. Now, as we go through the list, there's a few more in your list of reasons why you should have a long term. I mean, we haven't mentioned that for a while, but we're not talking about what's happening this week or next week because the rules are going to change. The world is going to change. This year, there's going to be challenges with an election and geopolitical problems, and you've got to avoid that and end up looking for things in the long term. So I really think you should start with the end in mind and choose the right assets that are going to be appropriate for you if you retire in 20, 30 years and then live for another 30 years. Your assets are going to actually hopefully outlive you as well and then passed on to the next generation. So correct asset allocation is critical, Stuart.
Yeah, and something I don't think property investors think carefully enough about as a sort of general observation, if you like. And the challenge, I guess, when investing in property is because it's such a lumpy asset, it's very difficult to get a perfect asset allocation as you're going through the journey of building wealth. So that is, if your long-term goal is, let's just call it half of my wealth in the share market, half of it in property, for instance. I'm not suggesting that's what it should be, but let's use that as an example. It's difficult to achieve that in our 30s, in our 40s, in our 50s, quite often because we're starting from a low asset base and we're doing the right things in the right order. Gearing into property is one of the first things that we should do. So it's entirely possible, in fact, probable, that in our 30s we'll be heavily invested into property and have very little invest in the share market, for instance. Now, that's fine. I don't suggest that we need to change that approach. But the asset allocation point was really about making sure by the time we get to retirement, which I would define as, wanting to have the flexibility to reduce working hours or stop working in full, it's important that you have the right asset allocation by that stage. So for the sake of this discussion, let's call it age 60. By the time I get to age 60, I want to have 50% of my wealth in property and 50% in the share market. And I might want to take that approach for instance, because I know I'm going to need some liquid assets. I'm going to know I need some assets that are going to have a higher income profile than property does after expenses. And I know that, I need to have lower sort of rates of gearing and those sorts of things. Whereas I find that property investors that don't have a long-term plan don't think about those things. And they get to the point, they get to say 5 years before retirement and then think, oh, hang on, what am I going to do with all this wealth? What am I going to do with the related debt in the property portfolio? I better go and get some advice. And that's fine. We can build a strategy in that situation, but it might have been more efficient to make different decisions 5 or 10 years prior to that situation. It might have, in fact, been more economical, particularly from a tax perspective, to do that. So having the long-term strategy gives you some sort of, and because you do some financial projections, gives you some sort of insight of what your asset allocation is expected to look like by the time you're 60 or whatever that retirement age is.
Well, one of the other asset allocation buckets is superannuation. I guess having a long-term plan would include a superannuation strategy, Stuart.
Yeah, by 1 July this year, the transfer balance cap, which is the maximum amount you can have inside super that is tax-free, or at least tax-free today. That could change, but it's always probably going to be concessionally taxed, is $2 million. So if you have a spouse, you can have up to $4 million of your personal wealth inside super that's going to be tax-free. Now, again, for property investors which tend to invest in property outside of super, that's a planning opportunity for them. And I say it's a planning opportunity, not a downside, because it's one of these things we need to think about. How do we eventually get most of that wealth inside super, or at least if we've got more than $4 million, at least then $4 million of that wealth into super, because it's pretty tax effective in order to do that. Now, you don't have to do that necessarily by the time you get to age 60, but it's really at some point, hopefully in your 60s, because you want to utilize the tax effectiveness of that vehicle, you want to start getting more and more money into super. But conversely, if your goal is to retire much earlier than age 60, which is when most of us can access super, or 65 if we're still working, then super's not going to play a big role in your ability to retire early, in which case then you need to probably have more of your assets outside of super. And you've got to think about the liquidity of those assets also, so that they're able to pay for living expenses. So I guess a long-term plan tells us how important super is in the strategy. And in some people's situation, it can be a very important part, and they shouldn't be ignoring it, and they might be today. And conversely, it could be not an important part of the strategy, but even then, I would argue at some point in their life, it will become important. You really need to think about just generally what role will super, and really, when I talk about super, I'm talking about the tax-effective vehicle. What role will super play in your retirement strategy?
Well, when I ask people what their biggest assets are, they normally look at their husband or wife and mention them because they think it's a trick question, and it's not. And then they'll say, okay, well, yeah, maybe the property at Smith Street. And I remind them that they are their biggest asset, and their income earning capacity is. And while they insure their cars and they protect their properties with insurance, they don't always protect themselves. It's something I used to do. I'm not insurable anymore at my age, and I don't need it because of where I am. But I believe at certain stages in life, insurance is an important part of your big picture plan.
So when we develop a strategy, the financial projections are really the first step of developing that long-term strategy, and is a really important piece of that puzzle. And it really helps us understand what the insurance needs of clients will be throughout the life cycle of that investment journey. And so if you think about people that are just starting off, typically maybe high income, low asset base, they're very dependent on their ability to get out of bed and earn income. And if they've got dependents and that person was to pass away, that would have a dramatic impact on their financial future as well. So in that situation, they have probably relatively high insurance needs. But the whole point of building wealth is to make sure that we're financially strong, irrespective of whether we're able to get out of work or want to get out of bed to go to work in the morning. And so it helps us understand what those insurance needs look like. And hopefully what we do is we have high insurance needs when we're young and insurance is relatively cheap relative to the benefit amount that we're going to get. But then as we move through life, of course, those premiums increase each year. But hopefully, if we're executing on our plan well, we can reduce the level of cover over time and get to a point where we're kind of self-insuring ourselves. And by taking that long-term approach and having a very comprehensive strategy, it allows us to, I think, balance out the costs of insurance. It's really funny though, Michael, clients that don't have insurance and have never had insurance, really difficult to convince them that they need some. And conversely, clients that have had insurance for many years, really difficult to convince them to let it go. So we've got to understand that there's some psychology here, but the benefit of the plan helps us really put our emotional decisions aside and really just focus on the numbers. And the numbers don't lie, right? So if we take the income out of a strategy because that person is incapacitated or passed away or whatever it is, we can demonstrate, hey, the strategy still works, or no, the strategy falls over. And I think it's a great way in order to frame insurance advice.
Well, there are lots of different sorts of insurance, and we're not going to give any advice on that here today because that's inappropriate. We're not qualified to do that without knowing, well, I'm not anyway, you're not without knowing people's circumstances. But if I could say, and it's not a recommendation, what I did, that was many, many years ago, 50 years ago, 40 years ago, was every time I bought a property, I upped my life insurance so that if I died, my wife at the time would have the investments unencumbered, no debt against them, so that it could provide ongoing support for her and the kids. As it happened, fortunately, I never have ever claimed on that or income protection insurance, but it gave me a level of comfort. I was able to sleep at night. There's one more in your list of 10 advantages. What's the last one, Stuart?
Last one is just really to navigate the inevitable changes in life. So again, that could be, a career change in income, change in living circumstances, so moving interstate or moving overseas and working overseas, changing goals in terms of when you want to retire. There's lots of things that life can throw at us. And when we have a well-defined long-term strategy, we can then really think carefully about, well, does this really change anything, or does the strategy remain intact? And I would say that should be the answer most of the time. Or if it's such a significant change, sometimes we need to tinker with the strategy a little bit. Quite often when it comes down to strategy, the best thing is to do nothing, which is to keep going and keep pursuing that long-term strategy, because it really should be flexible enough to accommodate some of these challenges. But I don't think there's one strategy that we've ever put together and over 10 or 20 years, it's gone perfectly to plan. There's always those unexpected things that life throws at us. And at least we've got the confidence then of knowing it's okay. It's not going to upset the apple cart in terms of where we're heading.
Yeah, Stuart, I believe you've got a bonus for us, one that you haven't got on the list here. What's the extra, the 11th bonus?
More holidays, Michael. Who doesn't want more?
I like that.
Yeah, who doesn't want more holidays? I was really thinking about it because, as I said before we started the record, I turned 50 at the end of last year. And so we're lucky enough, having my wife and I having invested for many decades, to be at the stage of life where we can really balance out living for today and investing for tomorrow. And, we still invest very heavily in both shares and property, of course. But knowing that we have invested over many, many decades and we still continue to invest allows us to enjoy some very enjoyable, luxurious, guilt-free holidays. And I think at the end of the day, who doesn't? Most of us would enjoy doing that. And so, putting that strategy together and executing and working hard on it for over the last number of years, I think puts us in that position. And also means that we're in a position now where we can work out, let's do another holiday. Like, it's not going to kill us and it's not going to have a negative impact financially. And who knows what our health is going to be in the years to come. So we may as well take that opportunity. And I thought that was a really good note to sort of end on.
I think so.
From a topic that tends to be very sort of factual and emotionless. I think there are some great lifestyle outcomes that come as a result of putting a long-term plan together.
Well, whether it's holidays or the nicer house or a fancy car or whatever, it's actually enjoying life, whether it's time with your grandkids or children. But that's great. So in summary, Plan to become the person you plan to become. Have an independent advisor help you put that plan together. Concentrate and focus on the long term, but that doesn't mean that you don't change the plan in significant circumstances change. Thank you so much. I'm going to leave a link to your blog in the show notes on this anyway, Stuart, and I look forward to catching up with you again next month.
Thanks, Michael. Been fun as always.
Well, I guess you heard from Stuart and you've heard it from me over and over again, the importance of having a big picture, long-term strategic plan. The challenge, of course, is where do you get that information and who do you listen to? So before I share my mindset message with you, I want to ask you a question. What if you could hear from all the people who've written the books and the podcast hosts, all those voices that you trust in one room just for you? Imagine having those people who've written your investment Bibles and podcast hosts there that you can ask your specific personal questions. Well, that's what's going to happen at Wealth Retreat 2025 when you're not only going to hear their presentations, but you're also going to be able to have real conversations about what's actually working today in the property markets and about future trends. This is your chance to ask your burning questions that you've had while listening to this podcast, while reading the books, while watching the YouTube videos. When you join us at the beginning of May at Wealth Retreat, you're going to be able to learn from the experts, but you're also going to build a network, gather a new peer group of like-minded investors ready to share insights, offer support, and grow together. And very importantly, you're going to get your personal questions answered. So please go to wealthretreat.com.au, check out the great faculty I've put together, and imagine what it would be like if you could take advantage of this new phase of the property cycle that's appearing, it's manifesting itself in front of our eyes at the moment. History's shown us that this stage of the cycle is when lifetime wealth is being created by those in the know. So don't miss this opportunity to learn the most advanced property, finance, structuring, risk management, business and tax strategies. Go to wealthretreat.com.au, register your interest. We'll be in contact with you, honestly tell you whether it's appropriate for you because it's an invitation-only event. But don't count yourself out because I look forward to seeing you on the Gold Coast at the beginning of May.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Mindset message today, I'd like to share with you what's probably the most important of all the rich habits, according to Tom Corley, my co-author of the international best-selling book, Rich Habits, Poor Habits. You may have heard or listened to our podcast with Tom before or read my international best-selling book, Rich Habits, Poor Habits. By the way, can I boast? It's actually been translated into 7 different languages. But you may have heard that Tom based his section of the book on a 5-year study of the wealthy people and the less wealthy, let's call them poor people. It's not a judge of people. And he found the habits that differentiated them. And there's lots of habits. And I know that if you've been listening to me for a while, you'd know that I think a mindset is a big factor in why some people are much more successful than others. But I recently spoke with Tom and asked him, what's the most important of all the rich habits? And he said, according to various studies, individuals who read for self-education earned 20% more than other adults who didn't have this growth habit. Those who read, and reading also means listening to podcasts and YouTube, but the right ones, not for fun, but for education. Those who read earned 20% more. And there was a number of different studies, one in Italy and Duke University, who actually studied New Zealanders, found that those who developed the reading to learn habit earned more income, had more assets, had better finances by the age of 38 than their peers. In fact, in Tom's 5-year study of the daily habits of the rich, he found 86% of the rich loved reading compared to 26% of the poor. 63% of the rich listened to audiobooks during their commute or podcast to work, while 5% of the poor did. 85% of the rich read 2 or more self-improvement books every month. 15% of the poor did. And 88% of the rich read 30 minutes or more daily compared to 2% of the poor. So Tom concluded that parents who instill in their children the habit of daily educational reading set their children up to earn more during their lifetimes. This habit, it turns out, follows kids into their adult lives. According to Tom, a recent study at Brown University, in which nearly 50,000 families were surveyed, concluded that habits in children are unlikely to vary after the age of 9. I mean, that's why I've often said that apple doesn't fall far from the tree, so you've got to instill rich habits in your kids early in life. Since most of those early years, your children are spent at home, the bulk of the habits children adopt, such as reading to learn, primarily from their parents. Now, I guess monkey see, monkey do. So one way you can instill wealthy habits in your children is by showing them, not just telling them, but showing them what you're doing. And therefore, my suggestion to you is that if you want to get to the next level, because you can change your habits, develop the habit of reading to learn rather than just reading for entertainment. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?